Ladies and gentlemen, today we turn our eyes to one of the greatest investors of all time, Warren Buffett. For decades, he has been the North Star for those seeking wisdom in the stock market, guiding us through recessions, booms, and the ever-changing tides of finance. Warren Buffett's investment track record is legendary. Over the past several decades, he has built Berkshire Hathaway into one of the most successful and admired companies in the world. His approach to investing has been studied, analyzed, and followed by countless investors, both professional and amateur. What sets Buffett apart is not just his ability to pick winning stocks, but his disciplined long-term approach to value investing. Buffett's journey began at a young age when he developed a passion for business and investing. He bought his first stock at just 11 years old, and by his teenage years was already making money through various ventures. His education at Columbia Business School, where he studied under Benjamin Graham, the father of value investing, cemented his philosophy of seeking undervalued companies with strong fundamentals. This principle has guided Buffett throughout his career and remains at the core of his investment strategy. One of Buffett's most well-known investment philosophies is to buy businesses, not just stocks. He looks for companies with strong competitive advantages, solid management teams, and consistent earnings. Unlike many investors who try to time the market or chase trends, Buffett focuses on businesses that he believes will generate strong returns over the long run. His famous quote, "Our favorite holding period is forever," underscores his belief in long-term investing. Buffett's ability to remain patient and disciplined, even in volatile market conditions, has been a key factor in his success. During times of market panic, when others are selling in fear, Buffett has often been a buyer. He has repeatedly emphasized the importance of being fearful when others are greedy, and greedy when others are fearful. This contrarian approach has allowed him to acquire great companies at discounted prices. A prime example is the 2008 financial crisis, when Buffett invested billions in companies like Goldman Sachs and Bank of America at a time when others were fleeing the market. Those investments paid off handsomely in the years that followed. Buffett's track record is also defined by his ability to adapt while staying true to his core principles. While he has historically avoided technology stocks, considering them outside his circle of competence, he made a significant investment in Apple, which has since become one of Berkshire Hathaway's most successful holdings. This move demonstrated Buffett's willingness to recognize value, even in industries he had previously avoided, showing that while his principles remain unchanged, his strategy can evolve when necessary. Another defining feature of Buffett's track record is his cautious and conservative approach to risk. Unlike many hedge fund managers and aggressive traders who rely on leverage and speculative bets, Buffett focuses on preserving capital and avoiding unnecessary risk. This strategy has allowed Berkshire Hathaway to grow steadily over the years without taking excessive losses. His philosophy emphasizes that investing should not be about making quick gains, but about building wealth consistently over time. Perhaps one of Buffett's most remarkable achievements is his ability to compound wealth over the long term. The power of compounding has been central to his success. By reinvesting earnings and allowing investments to grow over decades, Buffett has turned Berkshire Hathaway from a struggling textile company into a multi-billion-dollar conglomerate with holdings in insurance, railroads, consumer goods, and technology. His ability to spot undervalued businesses and hold on to them for years, even decades, has resulted in unparalleled wealth creation. In addition to his investment success, Buffett's transparency and straightforward communication have made him a trusted figure in the financial world. His annual shareholder letters are widely read and respected, offering valuable insights into his thinking and investment philosophy. He explains complex financial concepts in simple, relatable terms, making investing more accessible to everyday people. His humility and honesty, even in acknowledging mistakes, have only added to his credibility. Buffett's track record is not just about numbers and returns. It's about a disciplined, principled approach to investing that has stood the test of time. His ability to stay calm in turbulent markets, identify great businesses, and focus on the long term has made him one of the most successful investors in history. As the world watches to see his next move, one thing remains certain. Buffett's principles of patience, value, and long-term thinking will continue to be a guiding force in the investment world for generations to come. The current market environment presents a complex and uncertain landscape, shaped by a combination of economic, geopolitical, and technological factors. Investors are navigating a world of high interest rates, inflationary pressures, global conflicts, and rapid technological advancements. These elements create both risks and opportunities, and understanding them is essential to predicting how major investors like Warren Buffett might respond. One of the most significant factors influencing the market today is the state of interest rates. Over the past few years, central banks, particularly the Federal Reserve, have raised interest rates to combat inflation. Higher interest rates increase borrowing costs, making it more expensive for businesses and consumers to take on debt. This in turn slows economic growth and can lead to lower corporate earnings, affecting stock market valuations. For an investor like Buffett who focuses on long-term value, a high interest rate environment can create opportunities to buy strong businesses at discounted prices as the broader market struggles. Inflation is another crucial element shaping market conditions. Rising costs of goods and services erode purchasing power and impact corporate profitability. Companies with strong pricing power, those that can pass on increased costs to consumers without losing demand, are better positioned to withstand inflationary pressures. Buffett has historically favored such companies, often investing in businesses with strong brand recognition and essential products such as Coca-Cola, Kraft Heinz, and American Express. These types of businesses tend to perform well even in inflationary periods because their products remain in demand regardless of economic conditions. Beyond economic factors, geopolitical uncertainties are adding volatility to the market. Conflicts in various parts of the world, trade tensions between major economies, and shifting global alliances all contribute to market instability. Supply chain disruptions, energy price fluctuations, and regulatory changes create additional risks for businesses and investors. Buffett has always maintained a long-term view, often emphasizing that short-term geopolitical concerns should not dictate investment decisions. However, he remains cautious and avoids industries heavily impacted by geopolitical turmoil. His preference for U.S.-based companies with strong fundamentals reflects his belief in the resilience of the American economy despite global uncertainties. Technology is another major factor reshaping the market landscape. The rise of artificial intelligence, automation, and digital transformation is changing the way businesses operate and compete. Many investors are pouring money into AI-driven companies, seeing them as the future of innovation and economic growth. Buffett, traditionally known for avoiding high-growth tech stocks, has made exceptions in recent years, most notably with his investment in Apple. This suggests that while he remains a value investor at heart, he is open to investing in technology companies that demonstrate strong fundamentals, profitability, and a competitive advantage. The stock market itself has been experiencing heightened volatility, with sharp swings driven by economic data, corporate earnings reports, and investor sentiment. Speculative trading, fueled by social media and retail investors, has created unpredictable movements in certain stocks. Buffett has always warned against short-term speculation, emphasizing the importance of owning businesses rather than trading stocks. In a volatile market, his strategy of investing in stable, cash-generating businesses becomes even more relevant. Another important factor in the current market environment is corporate debt. Many companies took on significant debt during the low interest rate years, and as borrowing costs rise, some of them are now struggling to manage their liabilities. This presents potential opportunities for Buffett, who has historically stepped in to provide capital to strong businesses in times of distress. His investments during the 2008 financial crisis and the COVID-19 market downturns demonstrated his ability to capitalize on temporary weakness in fundamentally sound companies. Consumer behavior is also shifting, influenced by economic conditions, technology, and changing preferences. The rise of e-commerce, digital payments, and subscription-based models has altered how businesses operate. Buffett's focus on consumer behavior has guided many of his investments, particularly in companies with strong brand loyalty and essential products. He understands that no matter how much the economy fluctuates, people will continue to buy everyday necessities, use financial services, and seek reliable brands. As the market continues to evolve, investors are watching closely to see how Buffett will respond. His ability to assess the economic landscape, recognize value in uncertain times, and remain patient during market fluctuations has set him apart from short-term traders. While others react to daily news and trends, Buffett focuses on long-term fundamentals, ensuring that his investments withstand the test of time. In the face of high interest rates, inflation, geopolitical risks, and technological disruption, his investment strategy will likely remain rooted in his core principles: buying quality businesses at fair prices and holding them for the long term. Warren Buffett's decision to hold a massive cash reserve, currently exceeding $150 billion, has captured the attention of investors worldwide. This enormous cash stockpile is not just an incidental outcome of Berkshire Hathaway's operations, but a deliberate strategy that reflects Buffett's disciplined approach to investing. His philosophy has always been to wait for the right opportunities rather than deploying capital hastily. The fact that he has accumulated such a significant amount of cash suggests that he is positioning himself for a major move when market conditions align with his investment principles. One of the primary reasons Buffett holds so much cash is his preference for value investing. He looks for businesses that are fundamentally strong but temporarily undervalued due to market fluctuations, economic downturns, or investor panic. However, in recent years, valuations across many sectors have remained high, making it difficult for Buffett to find deals that meet his strict criteria. Instead of overpaying for assets, he has chosen to wait patiently, knowing that market corrections and economic cycles will eventually create opportunities. Another reason for Berkshire Hathaway's large cash reserve is Buffett's commitment to financial flexibility. Unlike many companies that rely on debt financing for acquisitions or expansion, Buffett prefers to have cash readily available so that he can act quickly when the right deal arises. This approach allows him to move decisively without the need to seek external financing, negotiate loan terms, or dilute shareholder value. It also positions Berkshire Hathaway as a buyer of choice in times of economic distress, when struggling businesses need immediate capital. Historically, Buffett has used his cash reserves to make strategic investments during market downturns. In the 2008 financial crisis, when many companies were struggling, he invested billions in firms like Goldman Sachs, Bank of America, and General Electric, securing highly favorable terms that later generated substantial returns. Similarly, during the COVID-19 market crash in 2020, Buffett had the opportunity to deploy capital into distressed assets. However, unlike previous downturns, he remained more cautious, exiting airline stocks and avoiding large-scale investments, signaling that he did not see sufficient value in available opportunities at the time. Buffett's decision to maintain high cash levels also reflects his cautious outlook on the current economic environment. With rising interest rates, inflationary pressures, and geopolitical uncertainties, he may be anticipating a market correction or a period of economic weakness that could create better investment opportunities. By holding on to cash, he ensures that Berkshire Hathaway is in a strong position to capitalize on undervalued assets when other investors are forced to sell due to financial constraints. Additionally, Buffett's cash strategy aligns with his belief in protecting shareholder value. Rather than making acquisitions simply for the sake of expansion, he prioritizes investments that will generate strong long-term returns. This conservative approach has helped Berkshire Hathaway maintain its reputation as a stable and reliable company, even during periods of economic uncertainty. Shareholders trust Buffett's judgment, knowing that he will deploy capital only when the right opportunity presents itself. Despite his preference for holding cash during uncertain times, Buffett is not opposed to returning value to shareholders when investment opportunities are scarce. In recent years, Berkshire Hathaway has engaged in share buybacks, repurchasing billions of dollars worth of its own stock. This strategy reflects Buffett's confidence in the intrinsic value of Berkshire Hathaway and provides a way to deploy excess capital while benefiting existing shareholders. One of the biggest questions surrounding Buffett's cash reserve is where he will invest next. Will he make a major acquisition, similar to his past purchases of companies like BNSF Railway or Precision Castparts? Will he increase Berkshire Hathaway's stake in existing holdings such as Apple or Occidental Petroleum? Or will he wait for a broader market downturn before making his next big move? Investors are watching closely, knowing that when Buffett finally deploys his cash, it will likely signal a major shift in the market. Buffett's massive cash reserves serve as both a strategic advantage and a reflection of his disciplined investment philosophy. His patience, financial flexibility, and commitment to value investing set him apart from many investors who feel pressure to constantly deploy capital. While some may criticize him for not making more aggressive moves in recent years, history has shown that Buffett's patience tends to pay off in the long run. As economic conditions evolve, the world eagerly awaits to see how and when he will make his next major investment. As investors try to predict Warren Buffett's next move, one of the biggest questions is where he might deploy Berkshire Hathaway's massive cash reserves. Buffett has always been strategic in choosing industries and companies that align with his long-term value investing philosophy. Given the current economic and technological landscape, there are several potential areas where he might focus his next big investment. One possible sector is energy. Buffett has historically shown a strong interest in energy companies, particularly those involved in oil, natural gas, and utilities. Berkshire Hathaway already has significant holdings in Occidental Petroleum and Chevron, signaling that Buffett sees long-term value in the energy sector. With geopolitical tensions affecting global oil supply and the ongoing transition to renewable energy, Buffett may choose to increase his stake in traditional energy companies or even invest in firms that are leading the way in cleaner energy alternatives. His investment strategy often revolves around businesses that provide essential services, and energy remains a fundamental pillar of the global economy. Another area of interest could be infrastructure. Buffett has a history of investing in businesses that offer stable, predictable returns, and infrastructure companies fit that profile. Railroads, pipelines, and utilities all have long-term revenue streams that align with his investment philosophy. Berkshire Hathaway already owns BNSF Railway, one of the largest freight railroad networks in North America, and has significant investments in utility companies. With the U.S. government increasing spending on infrastructure projects, Buffett may see further opportunities to acquire companies involved in transportation, construction materials, or large-scale infrastructure development. The financial sector has always been one of Buffett's favorites, and he could choose to strengthen Berkshire Hathaway's position in banks, insurance companies, or fintech firms. During economic downturns, banks often trade at lower valuations, creating opportunities for value investors like Buffett to buy strong financial institutions at a discount. Berkshire Hathaway already holds significant stakes in Bank of America and American Express, and if market conditions weaken, he may decide to expand his exposure in this sector. One of the most intriguing possibilities is whether Buffett will make a move in the technology sector. Historically, he has been cautious about investing in tech companies, believing that they fall outside his circle of competence. However, his investment in Apple, which has become one of Berkshire Hathaway's largest holdings, proved to be a game changer. Apple's strong brand, high profitability, and ability to generate consistent cash flow made it an exception to Buffett's usual avoidance of tech stocks. Given the rapid advancements in artificial intelligence, cloud computing, and digital transformation, Buffett may consider adding another major tech company to Berkshire's portfolio. However, he would likely focus on businesses with strong competitive advantages, significant cash flows, and long-term stability. Another potential target for Buffett could be consumer goods and retail. He has a long history of investing in brands with loyal customers, such as Coca-Cola, Kraft Heinz, and Dairy Queen. Even in economic downturns, people continue to buy everyday products, making consumer staples a relatively safe investment. If valuations become attractive, Buffett may look to acquire or increase his stake in well-established consumer brands that have strong pricing power and consistent demand. The healthcare sector is another area where Buffett could potentially invest. While he has been hesitant about making large-scale moves in this industry, Berkshire Hathaway has previously partnered with JPMorgan Chase and Amazon in an attempt to innovate healthcare services. Given the aging population and rising healthcare costs, Buffett may see an opportunity to invest in pharmaceutical companies, medical device manufacturers, or healthcare service providers that align with his value investing principles. Beyond specific sectors, Buffett could also take advantage of market downturns by making opportunistic investments. Historically, he has stepped in during times of crisis, providing capital to struggling companies in exchange for favorable terms. If the economy experiences a slowdown or a major correction, Buffett could deploy Berkshire's cash to acquire businesses at discounted prices, following the same playbook he used during the 2008 financial crisis. One wild card possibility is that Buffett could make a surprising move by acquiring a company outright. Over the years, Berkshire Hathaway has purchased companies like Precision Castparts, Geico, and BNSF Railway, adding them to its vast conglomerate. If he finds a business with strong fundamentals and an attractive price, he may decide to make another major acquisition before fully stepping away from his leadership role. Buffett's next big move will be guided by the same principles that have defined his investment career: buying businesses with durable competitive advantages, strong management teams, and long-term profitability. While many investors focus on short-term trends, Buffett takes a patient and disciplined approach, waiting for the right opportunity to deploy capital. Given his track record, whatever sector he chooses to invest in will likely have a lasting impact on the financial markets and serve as a valuable lesson for investors worldwide. Warren Buffett's investment philosophy has remained remarkably consistent over the decades, and it continues to serve as a blueprint for investors seeking long-term success. At the core of his approach is value investing, buying companies that are fundamentally strong but undervalued by the market. However, beyond just identifying good businesses, Buffett's strategy is built on a set of guiding principles that have stood the test of time. As investors anticipate his next move, it is important to understand the key elements of his philosophy and how they shape his decision-making process. One of Buffett's primary principles is the concept of investing in companies with a durable competitive advantage, or what he calls an economic moat. A moat refers to a business's ability to maintain its market position and protect itself from competitors. Companies with strong brand recognition, proprietary technology, economies of scale, or unique business models tend to have these advantages. For example, Buffett's investments in Apple, Coca-Cola, and American Express all reflect this principle, as these companies dominate their respective industries and have loyal customer bases that provide stable revenue streams. Another cornerstone of Buffett's philosophy is the importance of strong management. He believes that great companies are built and sustained by capable, ethical leaders who know how to allocate capital efficiently and grow the business over time. Buffett rarely interferes with the day-to-day operations of the companies he invests in, but he ensures that they are led by competent executives who share his long-term vision. This is why he has consistently praised Apple's CEO Tim Cook for his leadership and ability to maximize Apple's profitability while maintaining the company's reputation for innovation. Patience is another fundamental trait that defines Buffett's investment approach. Unlike traders who chase short-term gains, Buffett takes a long-term view, often holding stocks for decades. He famously said that his favorite holding period is forever, meaning that he buys businesses with the intention of owning them indefinitely. This principle allows him to avoid the noise of daily market fluctuations and focus on the intrinsic value of his investments when markets decline. He sees it as an opportunity to buy more rather than a reason to panic. His ability to stay calm during market downturns has earned him the reputation of being one of the most disciplined investors in history. Buffett is also known for his emphasis on financial strength and avoiding excessive debt. He prefers companies with strong balance sheets, consistent earnings, and a history of generating positive cash flow. Businesses that are burdened by high levels of debt are more vulnerable during economic downturns and rising interest rate environments. By investing in financially stable companies, Buffett minimizes risk and ensures that his investments can withstand economic challenges. This principle extends to Berkshire Hathaway itself, which maintains a conservative approach to leverage, allowing it to remain financially resilient during times of crisis. Another defining characteristic of Buffett's philosophy is his focus on simplicity. He invests in businesses that he understands, avoiding industries that are too complex or unpredictable. This is one reason he historically stayed away from technology stocks, though his stance softened with his investment in Apple. Buffett's view is that investors should stick to their circle of competence, meaning they should invest in companies and industries they can analyze and evaluate with confidence. This approach reduces the risk of making uninformed decisions based on speculation rather than fundamental analysis. Buffett's philosophy also emphasizes the idea of buying businesses at a reasonable price. While he recognizes that great companies deserve a premium valuation, he is unwilling to overpay for an investment. He looks for opportunities where the market has undervalued a company, allowing him to buy at a discount. This approach was evident in his purchases during the 2008 financial crisis when he acquired shares in major banks and financial institutions at significantly reduced prices. He believes that buying stocks at a fair price, or ideally at a discount, provides a margin of safety, protecting investors from potential downturns. Despite his reputation as a value investor, Buffett is also willing to adapt when necessary. While he once avoided technology stocks, he recognized Apple's unique position and strong business fundamentals, making it one of his largest investments. This ability to evolve without straying from his core principles is a key reason for his sustained success. He